Hi, in this video, I'm going to talk about the role of central banks in monetary policy and how they try to impact the economy through influencing short-term and long-term interest rates. And to illustrate this, I'm going to use a visual and I'll bring the chart up here. So this is the Canadian yield curve. So there's a few things that I want to walk you through here. The first thing, the dotted line, is the Canadian yield curve at the end of 2021. So at the end of last year. And the blue line is the yield curve at the end of March of this year. So the first thing that jumps out at you is that yields across the entire yield curve from 1 year all the way up to 30 years have risen considerably. So what that means is that interest rates have risen. As we talked about in previous videos, that means that future returns for owning bonds on that yield curve have gone up, but the current prices of bonds and bond funds that hold, Canadian government securities have fallen. So the first thing I want you to kind of take away is sort of what's gone on over the past 3 months is a significant rise in interest rates across the entire yield curve. And I have a lot of conversations with clients that are, I guess, are questions about what is the role of the central bank. And I think there's a lot of, impression out there that the central bank decides what the interest rates are going to be and then sets them. And then they are the ultimate decider on how interest rates sort of pan out across the yield curve and in the entire bond market. And my answer to that is, well, sort of. They certainly are a large player and they play a very influential role. They have tools that they use to be able to influence interest rates. But I would say that there's a lot of people that are contributing to bond prices and sort of setting interest rates across the yield curve. But for today's video, I want to talk specifically about what the mandate of central banks is generally and the tools that they're using. And some of these phrases I hope are things that you recognize, and I want to bring them to you in a way that is a little bit relatable and understandable. So the main policy goal of the Canadian Central Bank is to maintain sort of slow and steady inflation, like a healthy level of inflation around the 2% range. For years and years, like we haven't actually seen a lot of inflation in Canada. So if anything, Canada has sort of been struggling to bring inflation up to sort of its policy target, which is around somewhere in the 2 to 3% range. And over the past number of years, they've deployed a tool called quantitative easing, and I've put that on the chart on the right hand side. Basically, what quantitative easing is this: the Canadian central bank, it buys longer term bonds in the open market, longer term Canadian government bonds in the open market, and by doing that, what they do is they create more demand for bonds in the open market, which rises their price. More demand means higher price, and higher prices for bonds, as we've covered, means lower interest rates or lower yields. So the act of quantitative easing it's a fancy word for saying that the central bank of Canada became a really big buyer of bonds to keep pushing the bond prices up and push longer term interest rates down. And the goal of that, to maintain lower long-term interest rates, is so that individuals and companies can borrow longer term for lower rates. Lower long-term borrowing rates hopefully means more investment, which means more economic growth. That has sort of been the posture and the policy goal of central banks over the past number of years. So that's what they do sort of on the long end of the yield curve, which you're seeing on the right-hand side. On the short end of the yield curve, short-term monetary policy that the central bank executes is what's called managing the overnight rate. So that's the very short-term overnight rate. That's the rate that banks lend to each other. And so the Bank of Canada sets that overnight rate. So over the past number of years, they've been sort of pushing that rate down. When COVID hit, they wanted to push rates down across the entire yield curve so that banks would continue to lend each other, so that the economy would be able to survive, that people would invest and they would feel comfortable borrowing. Now what's happening is kind of a pivot in that posture. Now that we've seen inflation kick up, and there's a lot of narrative out there around what's causing the rise in inflation. It could be a number of different things. But regardless, what we're observing in Canada and across the developed world is that interest rates and inflation have been rising. And you can see that in the blue line is that now yields have risen. And think of it, maybe help you think of an investor that believes that inflation is now going to be higher. If they want to lend their money, if they want to buy a bond, they're going to demand a higher return for having their money locked up for a longer period of time. So it just makes sense that yields for longer term bonds would rise. like a rational investor, if they think that their money is going to be worth less as inflation ticks up, they're going to demand a higher return for holding longer term bonds. And that's kind of what you're seeing across the entire yield curve. And so the goal of the central bank, the policy of the central bank changes in this environment. Instead of trying to stimulate the economy by pushing rates down across the yield curve, they're trying to cool the economy down by raising interest rates or allowing interest rates to rise. And so on the short end of the yield curve, what central banks can do is they can increase the overnight lending rate. And that's what they're actively doing right now. So the Bank of Canada has risen short-term interest rates a couple times so far this year, and they're signaling that they're going to continue to do that. They're trying to cool the economy down, almost like throwing a bucket of hot water on it to kind of cool inflation down, cool the economy down. And then on the long end of the yield curve, I don't think the policy around quantitative tightening is yet clear, but quantitative tightening is basically the opposite of quantitative easing. Instead of buying long-dated Canadian government bonds, the government will be selling off long-dated government bonds that they have on their balance sheet. They're going to be pushing more bonds into the market, which will lower bonds prices and cause interest rates or longer-term interest rates to rise. And so two different postures for two different economies. In the past year and a half, we've sort of seen two stances from the central bank. And so that's sort of a quick primer on the main policy tools that central banks are deploying right now. And again, the main goal of the government is to, excuse me, of the central bank rather, is to try to manage inflation to a low, stable level, a healthy level, sort of between 2 and 3%. And those are the main tools that they have at their disposal in order to do that. Now, another thing I'll highlight here is I believe that the central bank has a very powerful signaling mechanism to the market. They have a main role to play, but they are one of many, many, many different people that are transacting and participating in bond markets. And it's, you know, in Canada, United States, internationally, like there's central banks that are participating in markets that are helping to influence interest rates to achieve kind of long-term objectives as it relates to inflation and economic growth. But they're one of many, many different, influencers in that market, private buyers, individuals, pension funds. They're all, through their buying and selling activities, they are themselves influencing long-term rates, and their expectations of future inflation and future growth of economies are setting or kind of signaling what interest rates are, setting interest rates over the entire yield curve. So long story short, central banks have a major role to play. They are a big player in terms of influencing interest rates across the yield curve, but they aren't the only player. So hopefully this has been helpful. When people say, you know, the central banks are deciding how interest rates are being set, my answer is, well, they're participating, they're influencing it to an extent, but they're one player, they're one participant out of many, many, many different market participants that's trying to influence, pricing in a way that helps economies thrive and grow over the long run. So hopefully you found this video helpful. There's more links in the description below to videos on fixed income. And if you like this video, give it a thumbs up, and I will speak with you soon. Take care.